IVM.
One of the best financial decisions I have made recently is shifting all my credit card payments to CRED. It's extremely easy and convenient. You're even reminded when your bills are due, and the app looks for hidden charges on your bills. So just pay your bills on time and stand a chance to win some amazing rewards. So don't miss out, download CRED and get paid for being good. Folks, welcome to Paisa Vaisa, brought to you by CRED, the most rewarding credit card bill payments app. I am your host, Anupam Gupta, P50 on Twitter, and this is a really special episode because for the very first time on my podcast, I've been wanting to do this for a really long time. Real estate is one of those topics which really needs to be discovered more. And guess what? Today I've got a real estate investment trust, a REIT, and that also the first one to list on the BSE. My guest, Vikaash Khdloya, Deputy CEO and Chief Operating Officer, Embassy REIT. We are going to be talking to him. But before that, let's take a short CRED convenience break and we'll be right back on the other side.
$100. That's all it takes to begin your journey with Bitcoin and Ethereum. No, really. With CoinSwitch, you can start investing in over 100 cryptocurrencies with just 100 rupees. On top of that, there are zero charges for deposits and withdrawals, so you can trade, buy, sell, however and whenever you want. All of this, plus their extremely intuitive interface, makes CoinSwitch the perfect app for beginners in the crypto space. But don't take my word for it. Just download CoinSwitch for free and try it out for yourself. If you'd like more information on cryptocurrencies, tune into a show about crypto with me, Rohan Joshi, my new adventure on IVM Podcasts. CoinSwitch, kuch to badlega.
And welcome back.
Vikaash, welcome to Paisa Vaisa. Thank you. Thank you so much for doing this for our listeners.
Thank you, Anupam, for having me over. It's a pleasure, and I'm excited to be on the show.
Let's jump right into it. So REIT globally in developed markets is quite well known, whereas it's a relatively new asset class in India. We've been wanting to do this for a very long time, regulatory wise. But just walk us through the history, okay? History in other geographies, how it developed, and then let's move to India. Let's start with that.
Sure, Anupam. Great. So REIT or real estate investment trust, these have been very established product for a very long period of time, over 50 years globally, especially, for example, in US itself, over 15 crore people or individuals have invested in this product. What it does is it gives individuals an opportunity to participate in the growth of the real estate story, whichever segment or geography it is. And, interestingly, over the last 25 or 30 year period, if you take the trends, REIT as a product has delivered better returns than the S&P 500 itself. So in that sense, REIT is an established product, an asset class. It has to be a core component of any portfolio, from whether it's from a diversification perspective or the returns perspective. And, we see over the long period of time, it has given pretty good overall total returns, even if you compare it, with other products in the market.
Okay. What were the main factors, right, for REIT to open up in India? I remember in the early 2000s, this was published, this as a concept, we've always been wanting to bring it in. But, what are the main factors that drove REITs opening up in India, and broadly on the commercial real estate sector, right? The potential, how has it panned out in the last decade?
Sure. So actually, this is a pretty interesting question. There are two factors, two key ingredients which went into making a REIT as a product accessible to investors, especially retail investors in India. So I'll break it down. One is obviously the opportunity itself, and I'll kind of explain in more detail what is this opportunity on the commercial real estate side in India. And the second one is Sebi itself coming out with a product which is well regulated, which is transparent, which offers retail investors opportunity to participate in this growth story of the commercial real estate. So, getting into details of the opportunity itself, if you recollect, early 2000s was the years where India started off as an outsourcing destination. In early stages, a lot of low-end kind of BPO kind of work was outsourced to India. But what's happened over the last decade and more is that India has become a true center, not just for outsourcing of low-end work, but really high quality, high-end up the value chain kind of activities conducted by some of the largest global companies, whether it's a technology company, whether it's a large global bank, whether it's a large insurance company. All of these large companies are looking more and more to India to offshore work here, basically to access the talent that India has. The key advantage that India has is that it has those talent, the people in those large numbers, given the advantage we have on the demographic side, with a very young population, and with our universities churning out about 20 lakh new engineers every year, right? So this STEM talent, as we call it, the science, technology, engineering, mathematics talent, is the key reason that the large global companies want to be in India, not just for the costs, but just to access talent at scale,
Sure.
which is available in India. So that's been the key turning point, I would say, for the India opportunity, because as these companies continue to grow, as these companies continue to offshore and bring more and more work to India to get it executed by the highly productive and talented Indian working population, so has also the demand for the real estate grown. And just to give you a sense, Bangalore, which is the largest office market in India, the rental growth, the growth in the rents has been at a 10% CAGR over the last 10 years. That's phenomenal, right? And if to top it all, ironically, the rents today in India are still at around $1 a square feet a month. So I would, jokingly, we always say and discuss that rents today in India are pathetically low. So you have on one side these global companies which are growing. I'll explain in detail how COVID has actually helped this offshoring and the entire technology and the digital movement and investments in digital transformation. And on the other hand, the rents continue to be very low. And there's a huge headroom as we move forward, because we're in a very sweet spot from a structural perspective, right? This is not cyclical for us. So that's the India, office opportunity. What's happened is, as larger and larger companies, the likes of Google, JP Morgan, the best companies you would name, they have come to India. So also India has moved away from what earlier we saw, the strata, low quality, sort of non-compliant kind of office buildings, to much more institutional quality, compliant and really high spec, large scale ecosystems, business parks. It's continued to move towards that. So that's again a sign of market maturing. So that's on the office opportunity itself. And then interestingly, what Sebi did is it's done a fantastic job on coming out with these REIT regulations. First draft came out in 2014, but then over a period of time, it kind of made amendments and changes to make it far more rigorous and investor friendly. And with that, we had the first REIT, which is us as Embassy REIT, got set up and got listed in April of 2019. Now, what the REIT product does is it gives the ammunition, it gives the opportunity for retail investors to participate in the growth story of the commercial real estate, but through a product which is transparent, which is regulated by the market regulator Sebi, which has liquidity because it's listed on the stock exchanges, and at the same time, which helps them to access the professional management teams to really play this opportunity at a larger scale, right? What the opportunity that they would have earlier without the REIT product would be to buy or participate in a strata floor in one building, in a particular location. Now with the REIT product, what it helps them is that they can kind of own a share, we call it a unit, in a REIT such as ours, and participate in a large portfolio, like a 44 million square feet portfolio we have spread across 4 cities, across 12 assets, and really diversify the risk. So that, I think it's just been, it's just moving the trend towards more institutionalization, and with more and more retail participation coming in as it gets more accessible.
So you've actually led me to the next question, right? Because the most logical question that I can ask you right now is, in fact, tell our listeners about the structure and framework of a REIT. You spoke about how REITs work. Let's talk about the specific structure and framework. I think it's a little bit important for our listeners, because we've got a rough idea that a REIT is like a mutual fund. But just explain this to us in some detail.
Sure, Anupam. So actually, a REIT at its very heart is very similar to a mutual fund. So what would happen in a mutual fund is that there would be multiple investors who would pool the investments into the mutual fund, and in turn, mutual fund would invest, whether it's equity, debt, gold, or whatever hybrid based on the charter. So in a sense, REIT does something very similar. What REIT does is it pools the investments from these investors, whether it's a retail investor, institutional investor, domestic or foreign, and then in turn makes the investments and infuses the monies in buying large scale commercial properties, which is the large business parks, which are 80% income generating. So the SEBI mandates that a bulk of the investments of the REIT, over 80%, has to be an income producing asset. So already fully stabilized, leased out to large global tenants, and whatever the returns or the rents collected from those underlying properties the REIT invests in is kind of flows through post all the expenses or at the operating level back to the investors. So at its heart, REIT is very similar to a mutual fund. It is managed by a professional management team such as us. We have in our management team over 200 employees. So that's a key advantage, that the investors get access to ensure that they have their investment managed by a professional team. And all the underlying assets are actually hard assets. They are, so the investors are investing in a product which is backed by tangible hard assets, which is the office building properties. Now, the question then would be, okay, but why do we invest in commercial real estate properties, and what's the benefits, right? So when we make investments in underlying properties, large scale properties, which are the best properties in each of the micro markets with large occupiers or tenants, what we are basically doing is we are investing in these properties which have long tenured lease contracts. Typical contract tenure for commercial leases in India would be anywhere between 7 to 15 years. So there's an underlying contract which is long duration. There are inbuilt escalations, for example, let's say 15% every 3 years. And to top it all, in India, there's a very unique phenomenon which we don't see in many other parts globally, which is the tenants or our customers invest in their own fit outs, right? Okay. So what that means is that they do the capital expenditure to make the furniture within the office premises that they take on lease, which makes them really sticky. So you have a product where investors pool in the money, invest in the REIT invests in the underlying assets, and the backing to the investments that we make is these long tenured contracts by these large global companies who anyways are in India for the talent and not for the rent savings. Rent is a very low proportion of the overall cost. Yeah. And to top it all, they are very sticky. It's very difficult for them to leave the space simply because they make massive capital investments in that asset. So it's a pretty robust structure, I would say. And in terms of, just to close off on the framework, REIT would have three principal components apart from the investors. One would be the sponsors. Now, sponsors would be akin to what we would say promoters in normal companies. They create the assets, they set up and get the REIT listed. In our case, the sponsors are the Embassy Group, the renowned pan-India based developer predominant in Bangalore. And we have Blackstone Group, which is a renowned private equity firm globally. So we have them as sponsors. The second component of the framework would be the manager, which is again the professional management team, which actually manages the assets, make the investments in new assets, and decides on the distribution to shareholders. And the third is the trustee, which oversees the activities of the manager and ensures that the assets are held in trusteeship with them for the benefit and as custody for the unit holders. So that's how the REIT framework is set up.
Okay, interesting. So before we go into a break, last question here is that Embassy was listed in March 2019. I think the IPO came out in 2019 and obviously set the precedent for REITs in India. Can you briefly tell us the journey of REITs till now?
Sure. So the journey actually started much earlier. So I remember 2012 is when we started setting up this Embassy REIT portfolio. And we worked on both the portfolio to build scale as well as to ensure, we have the regulations fully ironed out so that it's robust for the retail investors. And in April 2019 is when we listed Embassy REIT. Now, just in a span of 2 years from them, Anupam, what's happened is India today has 3 listed REITs with a total market capitalization of over 55,000 crores. That's a huge number. And amongst all the 3 REITs, they have listed and issued equity and raised monies totaling 17,000 crores. Right. So you've just seen how phenomenal the journey has been just in the last 2 years. And it's not surprising given how successful the product is globally. And just to give you a sense in terms of the market opportunity, India is a 600 million square feet kind of a grade A office space today. Mm-hmm. And between the 3 REITs, they currently own 15% of the overall grade A office stock.
Wow.
And I would imagine that this percentage only has to go up
Yeah.
faster, simply because this is the natural progression of and sign of market maturing. These large companies want to deal with institutional and more professionally managed landlords. And as the tenants grow, the demand for quality spaces, larger and larger spaces grows. More well-capitalized companies would come in let's say in the form of REIT, and they would continue to own and continue to grow larger and larger in size on the assets that they manage. So it's been a phenomenal journey last 2 years, and we think that it's only going to be, if not, as much, it's going to be even more kind of a exponential journey as we move forward.
Fantastic. Great time to take a break, folks, because on the other side of this break, you know what? We're going to talk exactly about how REIT works as an investment for you. Vikaash has just explained the entire landscape, the regulatory structure, the concept, the framework of REITs, and how commercial real estate can actually be accessible to people like you and me. On the other side, you know what? We're going to talk about how this works in your portfolio and the details, all the stuff about taxation, payouts, interest, dividend, all of that on the other side. So on that note, it's time to take a CRED convenience break. We'll be right back. Don't go anywhere, folks.
Do check out our new show, Tech Life at Intuit, hosted by Sheila Ditya Mukhopadhyay. Sheila Ditya talked to Anshu Verma, Vice President and Fellow Engineer, and Manish Shah, Distinguished Engineer Tech Futures at Intuit. They talk about Intuit's employee-powered approach that has won them many accolades and tons more. Here's what they say about evolving and innovating as a company. Catch new episodes of Tech Life at Intuit every Wednesday on the IVM Podcast app, website, or wherever else you get your podcasts from.
And welcome back to this episode of Paisa Vaisa, the Embassy REIT special. My guest, Vikaash Khdloya, Deputy CEO and Chief Operating Officer at Embassy. Vikaash, let's jump right into it. First, let's make the case for REIT being part of an investor's overall portfolio, right? So in your opinion, why should REITs form a core part of any investor's portfolio allocation strategy? Okay, first question. And obviously, who can invest in a REIT? Now, in mutual funds, we know that all you need is some 100 or 500 rupees to start an SIP or an initial investment. I believe the rules are a little bit different for REIT. So let's jump into it right now.
Sure, Anupam. Very interesting. So one, why should REIT be a part of anyone's portfolio? We think it is an established product class globally. It has been in existence for 50 years, and really it has delivered higher returns than the S&P 500 over a 25-year time period. So we think a REIT as a product has to be a core component of investment portfolio. Whether it's from a diversification perspective, whether it's potentially higher returns at lower risk. So let me kind of break down all the three components I touched about, right? One is diversification. Now, earlier, investors would, to participate in real estate and have it as a diversification, they would invest in strata-owned properties, most of them non-compliant and often illiquid, right? It cannot be sold easily and quickly. Now, with the REIT product becoming very popular in India and accessible to retail investors, now we have a product which enables the retail investors and the larger institutional investors to participate in this phenomenal commercial real estate story, which I just mentioned about, in a far more transparent, regulated, liquid manner, which is through the units which are listed on the stock exchange. So it helps them diversify. Now, I would say REIT as a product can be owned and invested by whether it's a millennial or whether it's a senior citizen, for two reasons. One, REITs in India are a total return story. So, there are two components to the return. One is the regular distributions, which is basically the rents that are collected are distributed back to the investors, post all the operating expenses and other follow-up expenses. And that's Sebi regulates that to be done once in 6 months, but we at Embassy REIT have gone one step ahead and do it once a quarter. So that forms the first bucket of the total return, which is the regular distributions or the dividend yield. And the second component, which actually is very unique to India and unique to the India commercial real estate story, is the capital appreciation. Now, in India, there are several levers for growth which REITs have, which helps to enhance the overall returns for the unit holders. There are organic levers. I mentioned about the 15% escalation on rents once in every 3 years. So that's automatic in the contract. Tenants continue to pay that as and when the time comes up. And second is the mark-to-market opportunity. Basically, simply put, the rents, because of the 15% escalation every 3 years, over a long period of time of the lease tenure, let's say 7 to 15 years, the rents actually on the contract fall below the market rent. So market is actually going much faster. So as and when these leases come up for renewal or expiry, we actually push the rents higher, lease it at market, and capture the market price. So in that sense, our portfolio is significantly under-rented today because of the legacy long tenure leases. Exactly. And Anupam, as and when these leases come up for renewal, we kind of have that opportunity to enhance the revenues, which means higher returns for investors. And the third lever on the organic side, which we have, is the development. Now, India is a growth story. Our occupiers continue to grow. They're expanding their businesses. And what we are doing in turn is also expanding our existing business parks. So we undertake development right now as we speak. We're doing 57 lakh square feet of new development. Now, all of that, as and when the buildings come up, become operational and are leased out, will enhance more returns. And the land cost is already paid for and reflected in the REIT units, right? And to top it all, right, we have the opportunity to make acquisitions. We did one large acquisition of 10,000 crores last December of Embassy Tech Village and enhance the returns for our unit holders. So why should it form a part of any investor's core portfolio? Simply put, it's a total return story. Every quarter they get the distribution yield, which is basically the rents which is collected from the underlying lease contracts, and there's an upside to optimize and maximize the returns through the various organic and inorganic levers, because of which the investors can get pretty attractive total returns. So that's the reason we think it should form a core part, and the REIT as a product is the best way to play it, simply because Sebi has put a lot of good requirements and governance standards in place by which at least 80% has to be in income producing assets. So there's a lot of stability, safety, and risk protection that the investors get, because it's largely in physical, tangible assets which are income producing. And Sebi has also mandated that at least 90% of the free cash flows need to be distributed back to investors, every 6 months. So that way, there's a regular flow of income, and they have the upside in terms of the capital appreciation. In terms of your question, Anupam, on who can invest?
Yes.
Similar to mutual funds, any retail or institutional investors can invest in REITs. Specific to retail investors, the only difference I would say from a mutual fund is the ticket size. Right now, the ticket size is 50,000 rupees. There are discussions going on with Sebi, the market regulator, and we believe very soon it should trade like other equity shares, which is, you can pick up just one unit, let's say, at 350 or $400, whatever that unit is trading at. So in that respect, it's fairly well accessible to retail investors.
Okay. Now the income side, right? I mean, there are ways in which I can earn money from a REIT, listed REIT. So I think one is the capital appreciation part, okay, which, that depends on the market, I guess. But more importantly, the payouts that the REIT gives to me as an investor. Let's talk about that.
Sure. So Anupam, just on your previous one, while the capital appreciation depends on the markets, but I would say in the underlying business itself, on the fundamentals, there are a lot of movers on enhancing the operating revenues, the income, which we believe should just then get reflected in the stock price, right? I spoke about the escalations, the mark-to-markets, and the new buildings that we are constructing. But just keeping that aside for a minute, right? Sure. On the payouts itself for retail investors, we go out there and pay quarterly distributions, while Sebi mandates minimum of 90% of the free cash flows to be distributed to investors. We have actually in the last 2 years distributed a full 100%. And that speaks volumes to both the structure, the product that Sebi has set up, because it gives those regular dividends to investors, and also about the quality of the underlying business that we have at Embassy REIT, because we have gone ahead over and above what the regulation mandates and made payouts of 100% of the free cash flows. So that's the payout that the retail investors can expect. And over and above that, of course, is the value accretion or the capital appreciation that they would get through all the underlying fundamentals of the business, which kind of then helps in capturing the value through the stock price appreciation.
Can we get some, probably some kind of numbers out here? Because in the market, a lot of people talk about dividend yields, saying that XYZ stocks pays out, let's say 5 rupees a share as dividend, and the stock price is 100. So you've got a dividend yield of 5%. And that's, people tend to compare that to an FD and stuff. Do we have any indicative broad numbers for the Embassy REIT?
Yeah, sure. So, over the last 2 years, just to put it in context, we have delivered 24% total returns, despite, operating most of the time of the last 2 years in the pandemic, like COVID, which has kind of been pretty severe on most businesses, right? So 24% total returns. We have distributed dividends of over 3,700 crores, Anupam. So again, just to put it in context, the dividend yield at the listing price would be about 7.5%. And then, of course, I mentioned about the stock price appreciation, capital appreciation due to the uptick in the stock price. So I would say it gives fairly stable returns, higher than the Government of India bonds, backed by physical assets which are income producing, large scale, best in class quality. And there's an upside in terms of all the organic and inorganic levers playing up, which should then get reflected through an appreciation in the stock price uptick.
Great. Taxation for individual people like our listeners. I'm guessing that the individual investors. So both, what is the taxation on the capital gain side and what is the taxation on the income side that I get? I mean, it's an annual or a quarterly income, whatever it is. So on both components, what is the taxation part?
Sure, Anupam. I think this is a very interesting and great question, simply because there's a lot of queries and a lot of confusion around how the taxation works for REIT. And honestly, ironically, the taxation is one of the huge advantages of the REIT, right? So let me kind of break that down. One of the best advantages that the REITs have compared to any other real estate operating companies or any other companies in India for that matter, is that the dividend distribution tax, the dividends are fully tax exempt. There is no dividend distribution tax applicable to any dividends paid by the underlying SPVs or the asset holding companies to the REIT and pass it through the investors. So that's a huge advantage, especially if you consider someone who in a 15, 20 or 40% tax bracket. There's no dividend dividend tax that's deducted and no dividend tax is applicable. It's fully exempt. Now coming to what our distributions comprise of and what's the component, right? To put it in full perspective, let me give you an example. Maybe it will be easier to understand. Let's say in one particular quarter, let's say last quarter Q4, we've determined that there's 100 rupees that needs to be distributed, which are the free cash flows to the investors. Now, of the 100 rupees, usually there would be three sub-components of the distribution. One, of course, I mentioned about the dividend. That's fully tax exempt. So let's say dividend was about 50 or 55 rupees of that 100 rupees. There's zero tax on that. Neither there's any tax deducted nor any tax needs to be paid by the retail investors. The second component is what we call as loan amortization. Just to simplify the jargon, loan amortization is basically what the asset or the office, the entities which are holding the office properties pay to the REIT, which then it pays to the investor. So because REIT is a pass-through, REIT assumes the same character of the income what it gets from its underlying SPVs. So in short, loan amortization, let's say, was another $20 in Q4 for Embassy REIT. So we spoke about dividend, fully tax exempt, 55 rupees of the 100. We spoke about loan amortization, which is another 20 rupees. So that takes it to 75 rupees of the 100 rupees, which is fully tax exempt. There's zero tax applicable on the 75 rupees of the total 100 rupee distribution. Now, the third subcomponent is what we call as interest, right? Again, that is interest which is paid from the asset owning SPVs to the REIT, which REIT pays to the investors. That takes the character of interest. Now, interest is taxable to the retail investors at the rate which is applicable to them, right? So it can be different for different retail investors. It could be 10%, it could be zero, it could be as high as 35%. So even if we, for simplicity's sake, assume it's a 25% tax, right? So, what investors end up doing is they end up paying 25% tax on the 25 rupees of the interest component, roughly, let's say 6 or 7 rupees of the total 100 rupees of distribution. So, tax, it's pretty tax efficient, right? The total tax on the 100 rupees that the investor ends up paying is 6-7%. Now, again, just to kind of qualify this, it all depends on what is the distribution mix. And that is the homework I would recommend retail investors do, on which REIT gives a maximum component of both dividends and loan amortization, because the more the percentage of these two components in the overall distribution, the lower will be the effective tax that they end up paying. So the dividends being tax exempt, I would say, is a huge benefit and one single most reason why, from a tax perspective, investors should start thinking of having REIT as a part of the asset allocation strategy. Now, coming to what is the capital gains applicable, I think again it's pretty interesting here, and the regulator SEBI has done a pretty good balancing act with the physical assets, real estate assets, sale and purchase capital gains, and the listed equities. So what happens is if you own a share or a unit in the REIT, capital gains tax is applicable when you sell it, but you have the benefit of the long-term capital gains, if you sell it post 3 years, and then it's only 10% that's applicable. And if you sell within 3 years, then a 15% tax is applicable. So just to sum it up very simply, on the distributions, tax is only applicable on the interest component, and the lower the interest component of the overall distribution, the better the after-tax returns to the investors. Dividends are fully tax exempt. And on the sale or purchase of the share or the unit of the REIT, there is benefit of long-term capital gain tax of only 10% if they hold it for 3 years or more.
Is that with indexation or without, or I've kind of forgotten that the rules?
No, they have the benefit. They have the benefit. And
Okay.
it's similar to equities. Only thing in this case, the period is 3 years.
Yeah. So, folks, just a small note out here. You guys might want to also check out my episode with Harsha of IndiGrid InvIT. Okay, because we've had an investment trust before on Paisa Vaisa, and that was the IndiGrid InvIT, which I thought was very interesting. So this is the second one. I've always found the taxation part to be seriously interesting. I mean, you've got an asset that generates maybe 6, 7, 8% via dividends, and you've got a pretty favorable taxation. So this trust structure is and as Vikaash has said, is actually quite pro investment.
Tell our listeners, how has Sebi made investments in REITs safe and transparent, with their policy and their regulation? Tell us that.
Sure, Anupam. So actually, Sebi, our market regulator, has done a fantastic job to ensure the interests of retail investors are protected. It has laid out a lot of checks and balances to ensure the vehicle, the REIT, is transparent, well regulated. So a couple of things. One, what Sebi has mandated is that the 80% of the value of the REIT needs to be in completed assets, income producing assets. What it means from a retail investor perspective is there is predictable and growing cash flows because the properties are completed and rented out. Only a maximum of 20% can be in under construction. So Sebi has really balanced it well, both on ensuring quarterly distributions through income producing assets, as well as there is the upside on the under construction portion because the yields or the returns on investment on the under construction are pretty attractive. So that's one very good move that the Sebi has laid out. Second, of course, Sebi has said that at least 90% of the cash flows, the free cash flows every 6 months, need to necessarily compulsorily be distributed to investors. So that means, there is no discretion with the REIT to, use those monies for other purposes than to distribute it back to investors. So obviously, REITs such as ourselves at Embassy REIT, we have gone one step ahead and said, no, not just 90%, we will distribute a full 100% and not in 6 months, but once a quarter. So I think that's a very retail friendly move by Sebi. Of course, on the third bucket, I will put all the other related party safeguards that Sebi has come up with. So there is lots of checks and balances in place. There's an majority vote required by shareholders on anything which is related party. Independent directors come in play. There's valuations that are required. So I think really very robust framework in line with some of the best in class what we see globally. And the last interesting bit, Anupam, which is a recent development which I want to share, is that Sebi has now reduced the minimum ticket size in investing in a REIT from what was 50,000 rupees earlier to now the latest announcement is it will be 1:1. So for example, if it's an Embassy REIT stock, you can buy it for as low as 350 or 360 rupees. What that means from a retail investor perspective is that whether it's a millennial or whether it's a senior citizen, they have easy accessibility to the product. Now, anybody can participate in the commercial real estate growth story of India and also get benefited from the total return story, which we spoke about, right? The dividends as well as the capital appreciation. And there is no minimum ticket size of, let's say, 5 lakhs or 25 lakhs we have in some of the other instruments like fractional ownership. And again, there is no lockup. So what we think the latest announcement by Sebi does is it makes it very accessible to retail investors. One, two, it will tremendously enhance liquidity of the instrument, the REIT stock units. What that will do is it will mean a better price efficient mechanism, which means again that the REITs get included in various indices of the NSE, BSE, which will attract a lot more institutional capital, the passive funds who track the index. So we think all in all, this trading lots, I would say the latest move by Sebi just about a couple of weeks back is absolutely fantastic, in line with what global REITs do. And I think that will tremendously change the landscape to the benefit of the retail investors.
Very interesting. Vikash, last couple of questions. We're almost winding down on the episode. This is in fact a very small question. How are REITs different from fractional ownership of real estate? Because this fractional ownership is something that's relatively new in real estate, at least in commercial real estate. Some firms are offering this as a service, probably to people who maybe don't have a very large corpus size to invest, and therefore this is one option. But how is REIT different from fractional ownership?
Sure, Anupam. Again, I think, as you rightly said, fractional ownership has recently caught on. I would say it is somewhere midway between owning directly the strata floors of the real estate and owning a unit in a REIT. So what fractional ownership does is gives individual investors an opportunity to participate, and have a certain share in, let's say, half a floor, one floor, or maybe a full share. Participate in a share in a one full building. Again, while it helps individual investors who have pocket size constraint or not investing in a full building or a full floor, we think REIT as a product is far superior and offers a lot more benefits than fractional ownership would, without any of the risks or the disadvantages that the fractional ownership would have. Now, let me give you 3 reasons why REITs work better for retail investors compared to fractional ownership. One, REIT, as I just mentioned, is Sebi regulated. So 80% income producing assets, minimum of 90% of the free cash flows need to be distributed, related party safeguards. So that kind of really ensures investors that they, whatever they invest in is robust, transparent, and well regulated. The second and the most important difference is that unlike fractional ownership units, REIT units are tradable on the stock exchange. So for any reason retail investors want to buy or sell, they can just do at a moment's notice, as you would do for any other equity share. So that liquidity, I think, is a significant advantage for retail investors, given this is a new product. So that's what you get as a benefit for the REIT versus fractional ownership. Third, of course, I mentioned about the dividends being fully tax exempt for REITs. I think, again, from a retail investor perspective, that's a huge advantage, because that is going to show up and in the overall returns, and they would be much higher, given that the dividends are tax exempt. So I think if you see all the 3 put together and add to that the massive scale, right? We own 44 million square feet, which is 440 lakh square feet. So any investor who invests in a REIT would get access and diversification by owning a share or a unit on such a large scale properties across India, across many buildings and across different cities. Again, just to give you an example, if I were to invest in a fractional, if I were to have a share in a fractional ownership kind of a setup, I would have exposure to one building, let's say maximum 1, 2, or 3 customers, right? But in a REIT today, we have 200 occupiers, 200 customers. So even if there is an issue, even if there is one lease where the occupier wants to exit, or the occupier, the customer, is facing some business headwinds, we have a huge pool and base of really large, high quality occupiers, tenants. And that really helps to ensure that the distributions are even and the risks are mitigated on the downside for retail investors. So in my mind, REIT is a far superior product compared to fractional ownership.
Yeah. Okay. Second last question: the performance of REIT since inception. I think you've been in existence, like you said, from 2010, but you've listed in 2019. What's been the performance so far?
Sure. So Anupam, let me first say what's happened over the last 2 years. We distributed 3,700 crores as dividends, and then to put it in context, we believe it is higher than all the other listed real estate companies put together on the Indian markets, right? So that's like the that's how strong the product is. There's cash flows that are available to the benefit of the investors. From a total return perspective, I mentioned it is a total return story. We've delivered 24% returns despite over a year of that 2 years that we've been operating in the full shadow of the pandemic, right? And then again, just to kind of drill down, okay, what's the performance been in the last 1 year, where there's been a lot of concerns around commercial office, a lot of businesses have had challenges. We have continued to be resilient. We have collected over 99% of our rentals. Again, goes to show the strength and the quality of the customers that we have. We have actually executed new deals, new leases of over 40 numbers, so 12 lakh square feet. So even during the pandemic, when there is a complete pause in decision making by customers, corporate occupiers, we have been able to successfully close 40 new lease deals over 12 lakh square feet. And the third and the most interesting part is that we've been able to collect the rent escalations. I mentioned roughly it is 15% every 3 years. We have been able to collect 100% of the leases where the escalations became due last year, which was about 88 lakh square feet. So on that 88 lakh square feet, we were successfully able to collect the 10 to 15% rental escalations. On average, last year we collected 13.5%. So despite the lockdowns, despite a full pandemic with a lot of concerns around work from home, we have collected over 99% of our rents. We have done new deals, and we have also collected the rent increases and been able to capture 100% of that. And that's kind of culminated and reflected in the over 1,700 crores of distribution that we paid out to investors even during the pandemic. So it's been a very resilient performance, and actually that's how the REIT product has played out. That during tough times it's resilient, and during the good times, it's a pretty good total return story.
Yeah, and logical question going forward, right? Because we started the episode. You spoke at length of India's core strengths. It's labor base, the 2 million engineers that we produce every year, the quality of international companies that are now present in India, and how you're pretty convinced about commercial real estate as an investment opportunity. So let's just wrap this up for people who are probably interested in knowing what's your outlook on commercial real estate going forward. I mean, knowing all these positive structural, like you said, not cyclical, but structural factors that are in place right now, how do you see the future panning out? What's the outlook on commercial real estate going forward?
Before I do that, and we are very positive on the way forward, let me give you a very quick anecdote. So I had met the India CEO of a very large global pharmaceutical company, let's say 3.5 years back. And I just, during a conversation, I was asking him, tell me, why are you in India and what's your plans? All right. So he said, we are in India, we're doing work which is on the initial stages of molecule development, which gets executed in the West. But, we have a lot of PhDs whom we hire. And my ultimate goal is to undertake molecule development in India. So we want to move up that value chain. And that's why we are in India. Like, that's fair, but you started off with a very little small space of 50,000 square feet. You've already grown to 8 lakh square feet in the premises. And we've just received feedback from your team that you're looking to double that up over the next 2 to 3 years. So I said, what's happening? What's this growth coming from? So he said, we are really bullish on India, really positive on the availability of talent. And, we really want to grow the India center to make it one of the largest, if not the largest trend center globally. And then I said, but why India? And he said, where else would I find, 700 PhDs, all super well qualified, right? High levels of productivity, technically really superior, abundant talent than in India, and that kind of really struck to me. That it's just the sheer availability of talent in India, which is what is driving some of these largest global companies here in India. It's not the rent savings, it's not the labor arbitrage. It's just the sheer availability of talent. Now, just to take this in context and kind of help explain what we think of the future of the real estate, commercial real estate, and the opportunity, we think we are in a very good space. Simply because the customers, the technology companies, I spoke about the large banks, we have insurance companies, we have online retail and e-commerce companies who are our occupiers. They have seen tremendous, phenomenal growth in some respects because of the COVID. So COVID has actually accentuated. We keep hearing of the record deal wins that the large technology companies have had. We continue to hear on the ground during our conversations that the large banks and insurance companies want to offshore more and more to India. and set up their own centers in India, which they were already doing before, but they want to expedite that more and more. So as the world continues to spend more on digital transformation, spend more on technology across segments, we think there will be more and more work that will come to India. So that's part one. The customers are growing.
Sure. Yeah.
The second is that the talent again continues to remain one of the key advantages of India. And to ensure these companies hire the best talent, attract and also retain them, they need to operate and provide them the best world-class facilities. And that is where the demand for really high quality, institutionally owned real estate comes in play. What we call it as the total business ecosystem. So gone are the days of having efficient floor plates and better air conditioning, etc. I think today real estate, what it means to occupiers, our customers and the employees is a lot more. There's a lot of focus on health, safety, wellness. The COVID will certainly ensure that the levels and the expectations are even higher, which plays very well to our strengths because we've always delivered and ensured we are ahead of the pack. And what it also means is there's a lot of focus on amenities, green spaces, open areas, landlords who can continue to invest in the buildings, whether it is the sense, with touchless sensors, the various other new technologies in a post-COVID world. So I think one, the customers are growing. Two, the real estate requirements are growing because they continue to hire a record number of people. A recent NASSCOM and Kotak research study projected that the hiring in this year alone would be higher than any of the numbers in the last 10 years. So they're hiring record numbers, and they want to ensure that this the space that they take up to attract and retain this talent is some of the world-class best companies, because rents really are a very small proportion of the overall costs. So that's the demand side of it. Now on the supply, something very interesting has happened, Anupam. As the world has seen the pandemic and there has been severe dislocations in the market, we have seen liquidity dry up. A lot of the hybrid developers, as we call it, developers who have residential, retail, hotels, and commercial office as part of their overall portfolio and balance sheet, they have seen a lot of severe stress in some of the segments, understandably slow, like retail and hotels have really struggled, right? And what that means is for pure play commercial real operators like ourselves, we've got that opportunity to build more and to capture that growth and demand, consolidate market share, because the supply is shrinking. A latest estimate by CBRE report estimated the supply has already shrunk by 25%. That's huge. And you on the one side, we're speaking about huge pent-up demand and a lot of requirement for better quality spaces by global occupiers. And on the second hand, we have this supply which has drastically reduced. So we really think this kind of ties up pretty well. And the last layer to that is, while there's been a lot of noise around work from home, I think whether it's the large global companies who are now ramping up people back to offices as the vaccination rolls out, or whether it's the statements made by some of the true world leaders, people who kind of drive some of the industry level trends, what we are hearing on the ground is that work from home is not sustainable. Even more so in a country like India, which has significant infrastructure challenges, whether it's the social infrastructure, people living in joint families, the demographic is pretty young. They share, friends share room, and then, they work away from their families as they build up their careers, or whether it is just the collaborative or the social interactions that they need, the mentorship that they need in offices. I think that it's a very clear trend that while there will be some amount of flexibility in the work styles, but the offices are here to stay. They'll continue to be used as a tool by occupiers to attract talent as magnets. So I think if you see all of these together, for well-capitalized companies who have a clear strategy on growing the commercial real estate portfolio, who already have scale, it's an opportune moment to kind of capitalize on this opportunity of phenomenal pent-up demand that we expect will come in the next 2 to 3 years, given the customers' businesses are growing. So we are very positive, Anupam.
Fantastic. I mean, I miss the studio myself, and I would love to go back to it. I hope that what you're saying comes true, because I'm also a believer in, the office, and a lot of people think there's a death of the office, but whatever. So folks, that's it. Fantastic. It's almost an hour-long discussion into REITs, and we covered pretty much all the aspects. So that's a wrap on this episode of Paisa Vaisa. My guest, Vikaash Khdloya, Deputy CEO and Chief Operating Officer at the Embassy REIT. Vikaash, thank you. Thank you so much for doing this for our listeners.
Thank you, Anupam. It's been a pleasure, and hope it was helpful.
Sure. And here's the CRED privileged tip of the week. Folks, keep a track of your expenses and have a budget. Believe me, this is really important. Sometimes our expenses tend to go out of whack completely and we don't have any control. Remember, folks, income minus expenses is equal to savings, and you need to be clear about that thing, because having had that equation, because you need to have a good savings balance for your financial goals in the future. So keep a track of your expenses, have a budget, and be in control, guys. Listeners, if you like this podcast, don't forget to check out other interesting podcasts on the IVM network. You can listen to us on the IVM Podcast app or ivmpodcasts.com. You can also follow us on our social media. We are IVM Podcasts on Twitter and Instagram. And if you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter. Thank you so much for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
IVM